The fourth learning objective shows how to journalize and post adjusting entries. The two basic categories of adjustments are prepaids and accruals. In a prepaid adjustment, the cash payment occurs before an expense is recorded. Accrual adjustments are the opposite. An accrual records an expense before the cash payment. Adjusting entries fall into 5 categories: prepaid expenses, depreciation, accrued expenses, accrued revenues, and unearned revenues. Prepaid expenses are advance payments of expenses. They are always paid for before they are used. For example, companies often make prepayments for rent, insurance, and supplies. Prepaid expenses are considered assets rather than expenses. When the prepayment is used up, the used portion of the asset becomes an expense via an adjusting journal entry. Some landlords require tenants to pay rent in advance. This prepayment creates an asset for the renter. Suppose SmartTouch prepays 3 months office rent of $3,000, $1,000 per month for 3 months. On May 1st, 2013, the journal entry would debit prepaid rent for $3,000 and credit cash for $3,000. After posting, prepaid rent has $3,000 debit balance. The trial balance at May 31st, 2013 lists prepaid rent as a debit balance of $3,000. Throughout May, prepaid rent maintains this balance, but $3,000 is not the amount of prepaid rent for the balance sheet at May 31st. At May 31st, prepaid rent should be decreased for the amount that has been used up. The adjusting entry transfers $1,000 or 1/3 of the $3,000 from the prepaid rent to rent expense. The prepaid rent is an example of an asset that was overstated prior to posting the adjusting entry. Notice that the ending balance in prepaid rent is now $2,000. Plant assets are long-lived assets, tangible assets used in the operation of a business. Examples include land, buildings, equipment, and furniture. As a business uses the assets, their value and usefulness declines. The decline in usefulness of a plant asset is an expense, and accountants systematically spread the asset's cost over its useful life. The allocation of a plant asset's cost to expense is called depreciation. Land is the exception. We record no depreciation for land as its value typically does not decline with use. The concept of accounting for plant assets is the same as for prepaid expenses. The major difference is the length of time it takes for the asset to be used up. Prepaid expenses usually expire within a year, but plant assets remain useful for several years. The adjusting entry to record depreciation is a debit to depreciation expense and a credit to accumulated depreciation. Accumulated depreciation is a contra asset account. The amount of depreciation is computed based on a depreciation method. On May 3rd, SmartTouch purchased furniture for $18,000 and recorded the purchase as a debit to furniture and a credit to cash. SmartTouch believes the furniture will remain useful for 5 years and then will be worthless. One way to compute depreciation is to divide the cost of the asset, $18,000, by its expected useful life, 5 years. So the depreciation for each month is $300. $18,000 divided by 5 years equals $3,600, divided by 12 months equals $300 per month. Notice that the adjusting entry for depreciation, we credited accumulated depreciation and not the asset account. Why is this? We need to keep the original cost of the furniture separate from the recovery or the depreciation of that cost because of the historical cost principle. Managers can refer to the furniture account to see how much the asset originally cost. Accumulated depreciation, rather than the plant asset account, is credited because it is helpful to keep the original cost in the plant asset account. The accumulated depreciation account holds the sum of all the depreciation recorded for the asset, and that total increases over time, or it accumulates, like the account title says. Accumulated depreciation is a contra asset, which means an asset account with a normal credit balance. Contra means it's the opposite. A contra has two main characteristics. A contra account is paired with and follows its related account. A contra account's normal balance, a debit or credit, is the opposite of the balance of the related account. The balance sheet reports both the plant asset accounts and the accumulated depreciation. But because it's a contra account, accumulated depreciation is subtracted from the plant asset account. The resulting net amount of the plant asset, cost minus accumulated depreciation, is called its book value. Furniture of $18,000 has accumulated depreciation of $300. Therefore, the book value of the furniture is $17,700. The book value represents costs invested in the asset and that the business has not yet recovered or expensed. Businesses often incur expenses before paying them. That is called an accrued expense. Consider an employee's salary. The salary expense grows as the employee works, so the expense is said to accrue. Another accrued expense is interest expense on a note payable. Interest accrues as time passes on the note. An accrued expense always creates a liability. Companies don't make weekly journal entries to accrue expenses. Instead, they wait till the end of the period. They make an adjusting entry to bring each expense and the related liability up to date for the financial statements. Remember that prepaids and accruals are opposites. Here are two examples of how to account for accrued expenses. Each day that employees work, a company incurs salary expense. Usually salaries expense is recorded on payday. At the end of a period, any salaries attributed to work done in that current period must be recorded. You debit salary expense and credit salaries payable for accrued salary. Note that both entries, debit and credit, debit and expense and credit are payable. This is an example of a liability that was understated before the adjusting entry was made. The second entry, the company is recording interest expense on a note payable. Interest expense is accruing each day the company has debt. Usually the interest is recorded when a payment is made. However, at the end of the period, any interest that has accrued must be recorded. You debit interest expense and credit interest payable for the accrued interest. Notice that both entries, debit and expense, and credit are payable. As we have just seen, expenses can occur before a company makes a cash payment for them, which creates an accrued expense. Similarly, businesses can earn revenue before they receive the cash. This creates an accrued revenue, which is a revenue that has been earned, but for which cash has not yet been collected. Since cash will be collected, a receivable account is debited. Since revenue has been earned, a revenue account is credited. Some businesses collect cash from customers in advance of performing work. Then the company owes a product or a service to the customer, or it owes the customer his or her money back. Only after completing the job will the business earn the revenue. Because of this delay, unearned revenue is also called deferred revenue. Unearned revenue is a liability account. When the company receives the advance payment from a customer, cash is debited and unearned revenue is credited. The adjusting entry decreases unearned revenue, a debit, and records revenue, which is a credit. This is an example of a liability that was overstated prior to posting the adjusting entry. An unearned revenue is a liability account, not a revenue account. The adjusting process has two purposes. The first one is to capture all transactions that should be reported in a period shown on the income statement. Every adjustment affects a revenue or an expense. And the second purpose is to update the balance sheet so that all accounts are properly valued. Every adjustment affects an asset or liability, but never a cash account. This table summarizes the accounting for adjusting entries. Note that each entry impacts an income statement account and a balance sheet account. Prepaid expenses involve debiting expense and crediting an asset. Depreciation involves debiting an expense and crediting a contra asset. Accrued expense involves debiting an expense and crediting a liability. Accrued revenue involves debiting an asset and crediting a revenue. And lastly, unearned revenue involves debiting a liability and crediting a revenue. Short exercise 3-5 identifies types of adjusting entries. The exercise continues on this slide. Exercise 3-22 asks you to journalize adjusting entries and analyze their effect on the income statement. Suppose the adjustments made in Requirement 1 were not made. Compute the overall overstatement or understatement of the net income as a result of the omission for these adjustments. Net income would be overstated by $10,500.